Okay, one of the more challenging aspects of accounting is accounting for the impairment of goodwill. Goodwill in general is treated in the Accounting Standards Codification Topic 350. We're going to look at the stuff that's in subtopic 20 there, which is accounting for impairment. So remember, if we have tangible long-term assets on our balance sheet, we're going to test those for impairment. Well, we're going to do the same thing with our intangible asset called goodwill. So let's do a quick review of accounting for an impairment on a tangible long-term asset. Let's say we had a building, we originally paid $1.5 million for it. It's got $500,000 worth of accumulated depreciation, so its net book value is $1 million. Remember, there's this odd two-tiered test for tangible assets. The first one, the recoverability test, I call it, will I get my money back? We'll look at the future cash flows that we estimate from this asset, and if the future cash flows add up to more than $1 million, we don't have to go any further. If they add up to less than $1 million, we have to do an impairment test. So let's say there's been some kind of impairment indicator, there's some kind of bad news from the local area, or maybe we're changing the use of this building, or maybe it's a hardware store that we own, and it's a little mom and pop operation, and Home Depot has opened up just down the street. So we got an impairment indicator. We're called upon to test to see if this asset's worth more or less than what it's on our balance sheet for. Well, first we have to do the recoverability test. So we sit down and we say, well, let's assume that we're going to get $100,001 of cash flow from this property over its remaining useful life of 10 years. You add all those up, you get $1,010. Since that's more than $1 million, we don't have to do test 2. However, suppose that we thought that we're only getting $90,000 out of this property for the next 10 years. Now this $900,000 is less than our net book value, and we have to go on to do test 2. We have to compare the fair value of the property to our net book value. In an accounting class, a lot of the times we use the present value of future cash flows to find the value of an asset. Just like we do with a bond, we can do the same thing with this building. Now, of course, in the real world, we might find the fair value by asking a local real estate agent or by looking for ourselves for comparable sales. But let's pretend like we're going to use our calculator to figure out what the fair value of this asset is. So we're going to find the present value of some future cash flows. So the first thing we do is hit second, clear time value of money to get everything out of the third row. We think this building's going to last us for another 10 years, so 10 is the end. Let's say that 6% is our incremental borrowing rate for 10 years, so 6 is the I. PV is what we're trying to find. We guessed that we were going to get $90,000 a year from this property. So that's our payment, and let's pretend like there's no salvage value, so there's no future value out here to make it complicated. We hit compute PV, and we find that the property is worth $662,000. Since it's on our balance sheet for $1 million, the difference between $1 million and the $662 is the impairment charge we have to take regarding this particular asset. Goodwill is a little bit different. We don't have that first, do I get my money back, because there's no cash flow coming out of goodwill. And so what we're going to have to do is we're going to have a different two-step process. First of all, we're going to have to check for goodwill impairment every year at a minimum. And then if we have a hint or some indication that the goodwill has been impaired, it's incumbent upon us to conduct an examination, even if it isn't our usual time of the year for doing that. So let's pretend like we bought a unit, we bought a company, and now it's a separate reporting unit in our big company. And it's on our books with goodwill of $900,000. The total assets are on our books for $2.9 million. The total liabilities are on our books for $500,000. So the net assets are $2.4 million. So let's say it's that time of year when we check for a goodwill impairment. We look and we quickly see that this division, this reporting unit, if you will, is worth, let's say, $3 million. Since $3 million is more than $2.4 million, we don't have to do anything. Same facts, except the only thing that's changed is that this reporting unit, instead of being worth, say, $3 million, we discover it's worth $1.9 million. So now we're going to have to do that second test. We're going to have to figure out what the implied value of our goodwill is. Our book says that these values are the same. The fair value of our assets and our liabilities are the same as the book values. In real life, of course, they're not going to be. We're going to have to go through a big hassle. It's a real pain in the asset to figure out what our assets are worth, what our liabilities are worth in fair value terms. And when we do that, we discover, ignoring goodwill for now, that our total assets are worth $2 million. Our total liabilities are worth $500,000. So our total net identifiable assets are worth $1.5 million. Well, if the whole division is worth $1.9 million, like we just said, and what we can identify is worth $1.5 million, that means goodwill should be in there for $400,000. But it's on our books for $900,000. So since goodwill was on our books for $900,000, we're going to have to book an impairment charge of $500,000 to get it down to its implied value of $400,000. So in other words, to recap, to go over it one more time, to repeat myself, to say it yet again, at least once a year we'll look at the fair value of our separate reporting units, and if it turns out that the fair value of that reporting unit is less than the book value of that reporting unit, we'll go on to do the second test, which is to find the fair value of our net identifiable assets, subtract that from the total value of the reporting unit to find our implied value of goodwill. If our implied value of goodwill is less than our goodwill on our books, we'll book an impairment charge to get it down to where it should be. Let's look at a real-world example here. Back in the early 2000s, Safeway went on a buying spree and acquired a lot of smaller regional grocery chains. They bought Dominic's, they bought back the half of Vaughn's they didn't own, they bought some stores on the East Coast, and they didn't work out very well. So you'll see in 2009 they've got a $1.9 billion charge to goodwill. It's called the Goodwill Impairment Charge over here. Notice that it's part of operations. It doesn't hang out down here somewhere as an extraordinary item. It's part of operations. That was the income statement. Let's look at the statement of cash flows. In the operating activities section, back in 2009, they had a net loss. You have to add back non-cash expenses. Here's the goodwill charge. If you think about it, the goodwill impairment charge is a non-cash expense. We didn't write a check for that. We're just debiting something called goodwill impairment. It's a lot like depreciation expense. Remember, we add back depreciation expense in the operating section of the cash flow statement because it's a non-cash expense. We subtracted it in order to calculate net income, but it really isn't a cash expense. And interestingly enough, you'll see they also have some property impairment charges. So remember, at the beginning of this video, we talked about looking for impairment on specific assets. Safeway had about $73 million worth of those charges in 2009 as well. And then here's their footnote. It says that they test for impairment annually on the first day of the fourth quarter, or whenever events or circumstances indicate that it's more likely than not that the fair value of a reporting unit is below its carrying amount. Talk about the two-step process that you guys already understand. And that's the way that a major corporation accounts for goodwill impairment. So by way of recap, when it comes to a tangible long-term asset, there's a two-step test. First, we see, are we going to get our money back? In other words, just add up all the future cash flows, and if it's greater than the net book value, no need to go any further. If it's less than the net book value, then compare the fair value of that asset to the net book value. If it's less than the net book value, book an impairment charge. When it comes to goodwill, it's a two-step test, but a little bit different. The first step is to compare the fair value of that reporting unit to its book value. If the fair value of that unit is worth more than what it's on our books for, not a problem. If, however, the fair value of that reporting unit is below our book value, our net book value, we're going to have to do a second step. We're going to have to find the implied value of goodwill. We're going to have to figure out what our net identifiable assets are worth, subtract our net identifiable liabilities, if you will, and come up with our net assets. Then we're going to figure out how much the goodwill should be on our books for to get us to what that total unit is worth. If that implied value of goodwill is less than what it's on our books for, we book an impairment charge. All right, I hope that helps.